Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And we begin in Turkey. The recent arrest of Istanbul's mayor and prominent opposition leader has triggered widespread protests across Turkey, escalating into a political crisis with severe economic repercussions. This is a space we've been following quite closely this last week or so. Investors are growing increasingly wary of Turkey's financial stability, prompting capital flight, currency depreciation, and market volatility that threaten to unravel the country's recent economic recovery. Following the detention, Turkish financial markets experienced their most significant downturn since the 2008 global financial crisis. The Borsa Istanbul 100 index plummeted by over 16% at its lowest point, with sharp declines in banking and industrial stocks. Short selling was temporarily banned by regulators in a bid to stabilize the market, but investor sentiment remains fragile. Foreign investors pulled an estimated $16 billion from Turkish assets within days, exacerbating downward pressure on the lira. The central bank intervened aggressively, burning through more than $25 billion in reserves to stabilize the currency. Despite this intervention, the lira remains at historic lows, hovering around 40 to the US dollar. Analysts warn that if central bank interventions continue at this pace, Turkey's financial buffer could be severely depleted in the coming months. Turkey's finance minister and the central bank governor have sought to reassure investors by reaffirming Turkey's commitment to market-friendly policies. Their efforts helped stabilize the lira temporarily, but concerns persist that President Erdogan could dismiss them, a move that would further erode confidence in Turkey's economic governance. Many investors have returned to Turkish markets over the past year, lured by high interest rates, currently at 50%, and economic stabilization measures. However, political instability has reignited fears that Erdogan could revert to unorthodox economic policies, such as rapid rate cuts and state-directed financial interventions, which previously contributed to runaway inflation and currency depreciation. The political crisis is likely to have lasting effects on Turkey's key economic sectors. It's worth touching on some of these. Banking and finance, increased refinancing costs and capital outflow threaten liquidity in Turkish banks, while a weaker lira raises concerns over foreign-denominated debt. Real estate. Heavy reliance on foreign investment makes the real estate sector vulnerable, with political uncertainty leading to potential decline in property demand and financing challenges. Exports and trade. Raising exchange rate volatility increases hedging costs for exporters, reducing competitiveness and making Turkish goods more expensive for international buyers. And tourism. While experts believe the tourism sector will remain resilient, the crisis could dampen traveller confidence, particularly if protests intensify or security concerns escalate. Despite immediate stabilization measures, the long-term economic impact of this political turmoil remains uncertain. Turkey's central bank still has reserves to intervene in currency markets, but sustained capital flight could force policymakers into tough decisions, including raising interest rates further or implementing capital controls. Erdogan's crackdown has also complicated Turkey's relationship with international partners, particularly the European Union and the United States. While Western leaders have largely refrained from strong condemnation, ongoing political unrest could strain Turkey's diplomatic and economic ties. As protests continue and opposition leaders call for early elections, Turkey faces a critical juncture. The government's response will determine whether it can restore investor confidence and maintain economic stability, or slide deeper into financial and political crisis. Next up, we now move to North America. The United States' federal debt is projected to surpass its post-World War II peak in the coming years, according to a new report from the Congressional Budget Office, CBO. The CBO forecasts that the debt-to-GDP ratio will reach 107% by the 2029 fiscal year, exceeding the previous high set in the 1940s, and will continue climbing to 156% by 2055. For 2025, the debt-to-GDP ratio is expected to hit 100%. The warning comes amid increased concerns over America's public finances. Moody's recently cautioned that President Donald Trump's tariff policies could undermine efforts to control the country's ballooning federal deficit by driving up interest rates. The CBO also noted that the mounting debt could slow economic growth, increase interest payments to foreign debt holders, and constrain policymakers' options. Despite the rising debt, the CBO's latest projections indicate a slower rate of increase compared to prior estimates, attributed to expectations of lower interest rates, reduced Medicare spending, and higher revenues. To address the fiscal challenge, the US president has tasked billionaire Elon Musk with identifying $2 trillion in spending cuts by mid-2026. The administration is also considering further tax reductions, including a proposal to lower the corporate tax rate from 21% to 15%. However, analysts at the Peterson Institute have challenged the administration's assertion that tariff revenues will offset the revenue losses from tax cuts. The US government continues to run substantial budget deficits, and with slower economic growth forecasted, long-term fiscal pressures remain a significant concern. Whether the current administration can turn this around will be one of the spaces to watch closely over the next few years. Now, if you're getting some value from today's episode of Market Update, don't forget to hit the like button. And if you want to continue to be on top of the most up-to-date analysis on global economic trends and markets, maybe consider subscribing. Next up, we move to Asia. As the United States prepares to announce reciprocal tariffs this week, India is scrambling to mitigate potential economic fallout. The move, spearheaded by President Donald Trump, aims to equalize American tariffs with those imposed by its trading partners, targeting what the administration calls the Dirty 15, nations with high tariffs and non-tariff barriers. India, with its significant trade surplus with the United States, is a prime candidate for scrutiny. In 2024, the US recorded a $45.7 billion goods trade deficit with India, which maintains an average tariff rate of 17%. Trump administration officials have long criticized India's protectionist stance, with one White House official dubbing it the Maharaja of tariffs. Washington has expressed particular frustration over India's agricultural and industrial tariffs, demanding greater market access for American goods. To soften the impact of US tariffs and secure a long-awaited trade deal, India has already taken steps to lower import duties on select American products. Tariff reductions on large motorcycles, luxury automobiles, and bourbon were announced before Prime Minister Modi's February visit to Washington. Further cuts are expected in agricultural products, autos, and other key exports from the United States. Additionally, India's recent budget includes scrapping the 6% digital services tax on online advertising, a measure Washington had previously criticized as unfairly targeting US technology giants. However, it remains unclear whether these concessions will be enough to prevent retaliatory tariffs. With negotiations ongoing, India is balancing economic pragmatism with its long-standing protectionist policies. The coming weeks will determine whether its efforts can shield it from the brunt of America's tariff escalation. Meanwhile, Indian investors are flocking to gold exchange-traded funds, ETFs, in record numbers as domestic equities falter and gold prices reach all-time highs. With concerns over economic and policy uncertainty, net inflows to gold ETFs reached $437 million in January and $230 million in February, according to the Association of Mutual Funds in India, AFMI. Analysts attribute this trend to India's long-standing affinity for gold and the accessibility of ETFs for retail investors. Vishal Gain, CEO of Zerodha Asset Management, which offers a gold ETF, observed this week, quote, "Historically, Indians have had an affinity for gold. A lot of people are now moving towards gold ETFs for investment purposes." End quote. While India accounts for just 2% of global gold ETF holdings, it remains the world's second largest gold investor after China, according to the World Gold Council, with a recent report observing, quote, "There has been a shift from gold jewelry into pure investments." End quote. The surge in gold ETF demand contrasts with a struggling stock market, as the Nifty 50 index has declined 0.5% year to date. Meanwhile, gold has outperformed, gaining 16% in the same period. The trend has also fueled a rise in gold-backed loans, which grew 74.4% between April 2024 and February 2025, highlighting the metal's role as a financial safety net amid economic uncertainty. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Monday, and I will see you all tomorrow.